valuation that led success soar high. I will achieve, I will fly high. IDBI in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show. My name is Ishan Gera. In this week's episode, we will discuss the significant banking developments of the week, including IDBI Bank's valuation. We have an interview lined up with Rajeev Yadav, Managing Director and CEO of Fincare Small Finance Bank. In our Banking for You section, experts explain the expected credit loss model which the Reserve Bank of India is planning to adopt. And our banking expert Tamal Bandyopadhyay discusses the HR issues relating to banks. At the end of the episode, we shall discuss the results of our last poll and ask you the question for this week. So stay tuned. The government is finally ready to let go of a public sector bank and is commanding a 33% premium on it. Earlier this month, it invited bidders for a 60.72% stake in IDBI Bank, and last week's news reports suggest that it is looking to make $7.7 billion from it. The current market valuation for the bank is $5.8 billion. The sale of IDBI Bank is expected to open the doors for the privatization of two public sector banks, which was announced in the budget. However, that would require a parliamentary nod. IDBI Bank's performance is also priming it for sale. The bank recorded a 46% jump in profit after tax in the second quarter of FY23. Net interest income was up 48%. But that is the case across the banking sector. IDFC, ICICI and HDFC all recorded a profit surge as they announced their results over the week. Net profit for ICICI rose 37%, beating estimates. However, there are warning signs of this growth. As banks record a rise in loans and advances, deposit growth has lagged. Talking about lagging performance, and the rupee comes to mind. The currency dropped below 83 against the dollar in trades last week before stabilizing around the 82 level. It is currently trading at 82.63 against the dollar. The RBI has been emptying its war chest to stave off rapid depreciation. The forex reserves fell $4.5 billion in the week ending October 14th to $528 billion. The level of reserves is now the lowest since July 2020. In July, the central bank introduced a mechanism of settling trade in rupees but could not find many takers. UCO and Yes Bank, media reports suggest, seem to be coming on board now. The banks have partnered with a few Russian banks to facilitate trade settlement in Indian rupees. The banks will have to set up special Vostro accounts to facilitate transactions. The move is expected to bring gains for India, especially in stabilizing and internationalizing the currency. A discussion on strategies would not be complete without a reference to small finance banks. They have found niche areas to operate in and have made a name for themselves. Business Standard's banking editor Manojit Saha had a conversation with MD and CEO of Fincare Small Finance Bank, Rajeev Yadav, to discuss the bank's strategy and the preparations for the IPO.
Hello and welcome. Fincare Small Finance Bank revived its IPO plans and has now refiled the RHP with the market regulator. Rajiv Yadav, MD and CEO of Fincare Small Finance Bank, is here with us today to discuss the bank's plans and strategies. Mr. Yadav, welcome to the show.
Thank you, Manojit. Thank you for inviting me.
Sir, in August, Fincare has refiled the IPO papers with SEBI. When are you planning to come up with the IPO?
So, Manojit, we we'll try and work within the validity of our approval and try and launch it within the validity period, which is typically 1 year.
So the validity period is next year, March, is it?
No. So depending on the formal approval date, it will be 1 year from the formal approval date. So it should be typically 12 months forward from now.
There are certain challenges which you faced in the last financial year. For example, your profit fell to 5 crore from about 146 crore in the previous year. Your credit costs remained very high at around 4%. Gross NPAs were almost 8% as on March 22. Do you think those parameters, are there signs that there are visible changes in those parameters?
Absolutely. So again, I would encourage for you to reference some of the industry parameters, and the pro of the financial inclusion space that we have is that there's a huge untapped market. There is financial inclusion to be done. There are underbanked, they are unbanked. So there is a huge opportunity. But one of the cons is that the COVID has impacted that segment significantly. There is a significant nature of unsecured loans, and therefore one of the cons is that some of the delinquencies and NPAs got elevated in the COVID times. As you rightly pointed out, the bank had elevated NPAs, but they all peaked, a few quarters back. And again, the industry data is out there to give a reference to some of those numbers. The pre-COVID numbers, the bank's GNPA was under 1% with a net NPA of under 5 or 0.5%. So once the COVID impact on the portfolio eases up, and which largely the industry is seeing at this point of time, we should come back to more reasonable NPA and net NPA numbers. Although we should be broadly ready for a slightly different portfolio behavior given a difficult time. But as a CRISIL reports, as the ICRA reports are indicating, FY23 should be a much more profitable years for these industries, and clearly the NPA numbers will be much lower because in that phase.
One of the area of concern was collection efficiencies. Are you seeing those things going back to pre-COVID levels?
Clearly, the industry has started seeing the collection efficiencies in the early buckets going to nearly pre-COVID levels, and clearly the impact of a crisis in some of the portfolios that we have is about 3 to 6 months after the crisis. And on the extreme side, the portfolio shows its true impact in about 6 months' time. And as you would realize that the last impact on the portfolio was in the wave 2, which was in April, May, June of 2021. And therefore, the worst of that impact would typically flow from the July to the December period of 2021. And then it is broadly, it normalizes to a reasonably pre-impact period. But in that phase of a crisis, obviously certain segment of customers would have become delinquent and they might become NPAs. But the people who are good in that, at that point, or what we incrementally build after that, tends to behave like a pre-crisis kind of collection efficiencies. And within the NPA pool or the delinquent pool, there has to be stabilization of the customers in terms of not is to encourage them to stabilize and start paying one EMI, and there's obviously recovery to try and roll them back. But fundamentally, the main pool, which is the non-delinquent pool, start behaving like pre-COVID roughly about 6 months after a major crisis. So 2022 has been largely in that direction across the industry of near normalization on the non-delinquent pool of customers.
So since we are talking about the micro loan customers, now small finance bank, which were earlier MFIs, they become small finance bank. I think 9 of them of the 10 who got the licenses. One of the challenges has been to diversify the portfolio. Their portfolio is very much tilted heavily towards the microfinance loans, even after 5 or 6 years of operation. And Fincare is no exception. I think 80% of your loans are towards the MFI customers. What is the plan to diversify the portfolio?
Right now, at least our data, what we have disclosed in the March 22 numbers, and if I can reference that, our diversification at that point was about 25%. In a larger context, the bank has a phase of what we call the build of the bank. And in the build of the bank, the most important build of the bank becomes the deposit franchise, because we did not have any deposit franchise earlier as a category. The second important category which gets built in is about the technology of the bank, because the technology is a hugely different ballgame. Just because it's a small finance bank, people do not have any different expectations from a mobile banking application, from our internet banking application, from our payment solutions. So you have to quickly catch up on all these technologies, besides all the infosec requirements and all the complicated compliances which come with the technology of the bank. So therefore, the second big build is out there. The third big build for a bank is on the compliances, the governances, all the nitty-gritties which make a bank run as a bank franchise. Now, loan assets is one part of it. In that phase, what you're trying to do is you're trying to build the remaining portion of the bank in the first 5 years. And also what you're trying to do is you're trying to diversify. But again, you have to be careful. If we're in a world where these customers are untested customers typically that we lend to. And we are very, we have to be reasonably conscious of the credit risk that we take. They have to be calibrated. So diversification is necessary for an institution, for a bank over a point of time, but has to be done in a very calibrated manner. When we look at the balance sheet that we started, I don't have the precise number, but they were under 2,000 crore. And today our gross loan advances are about 7,600 crores. So, on a static balance sheet or a slow growing balance sheet, diversification is easy. But on a fast paced balance sheet, diversification as a percentage is that more challenging. So in absolute terms, we would have added virtually as much as what we had of microfinance when we started the bank, but fundamentally as a percentage is reached about 25%. But this crisis has given an opportunity for us to build a lot of secured capability in this phase, because as microfinance hit a hurdle, the effort of that side of the business went into focusing with the customers, getting normalcy in the processes, working through their EMIs that they missed. So that business naturally went through a relatively slower phase. And from a bank's perspective, it opened up a window where the secured portfolio could be built at a faster pace, and therefore the mix is, in my view, across all the SFBs, and some of the numbers are in the public domain of the other SFBs. You would see the mix change. So I would think the need, firstly, the crisis did highlight the need for more diversification.
Right.
Two, the timing of the maturity of the bank was already there, and three, it just gave us the bandwidth to build a lot more secured, capability in this phase. So we are at about 25% right now, and I do see an accelerated pace. I'm trying to stay away from giving specific numbers.
I understand.
But other than that, I can say that I do see a reasonably faster pace of secured mix buildup in the portfolio.
Right. On that note, it was a pleasure talking to you, Mr. Yadav. Thank you so much for speaking to us, and wish you all the best for your IPO.
Thank you, Manojit. Really nice talking to you, and looking forward to more interactions in the future.
Yadav says the bank has seen 25% growth during the COVID period. He points out that the growth rates will return to normalcy now that the sector is performing well. The central bank is changing the rules of the game. In September, RBI Governor Shaktikanta Das said RBI would soon be coming out with a discussion paper to transition banks to expected credit loss regime. In our Banking for You section, experts explain what expected credit loss or ECL is and how it differs from the current approach.
The Reserve Bank of India, or RBI, wants banks to adopt the expected credit loss regime, or ECL regime, to provision loan assets. It will shortly come out with a discussion paper on the transition, said the RBI Governor Shaktikanta Das in September. Implementing the ECL impairment framework will force banks to become proactive in assessing the buildup of stress in their borrowers' books. The ECL is a forward-looking approach, and it will lead to early recognition of credit losses. This is in line with the Bank of International Settlements Financial Stability Institute Connect document. When implemented, banks will have to proactively look into the ECL and take on board past, current, and future information and update the ECL at each reporting date to reflect changes in the credit risk of their borrowers. As on date, banks in India follow the incurred loss approach, even as non-banking financial companies or NBFCs are on the ECL framework. It may be recalled that banks were to follow the Indian accounting standards, which includes ECL, from April 1, 2018. But it was deferred as legislative amendments were needed to the Banking Regulation Act 1949. Implementation was also dependent on their level of preparedness. The bigger NBFCs, however, went ahead with these standards from April 1, 2018. Delays in recognizing losses worsened the downswing during the financial crisis of 2007-09. Faced with a systemic increase in defaults, it led banks to make higher provisions. This worsened systemic risks, as banks' capital eroded precisely when they needed to shore it up. Moreover, the delay in recognizing loan losses and the consequent higher dividend payouts reduced internal accruals to the capital. The experience prompted the G20 and the Basel Committee on Banking Supervisions to recommend modification of accounting practices to accounting standard setters. This incorporated a more forward-looking approach rather than requiring losses to occur before they could be recognized. It encouraged the adoption of provisioning standards that require using the ECL model rather than the incurred loss models. The RBI said it would soon come out with a discussion paper on introducing the ECL framework for banks to seek feedback before its implementation in financial year 2024.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. IDBI in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
As of date, banks follow an incurred loss approach model. On the other hand, the ECL is a forward-looking approach leading to early recognition of credit losses. Like many other industries, banking is also battling talent attrition. As their employees get poached by fintechs, neobanks and other tech companies, our consulting editor and banking expert Tamal Bandyopadhyay tries to decode the reasons behind this competitive environment. Tamal says that the change in the nature of banking is bringing about these changes. Hi Tamal, thanks for coming on the show.
Thank you.
Now, this week's column was very interesting because it discussed the HR issues at bank, which are rarely discussed. Now, the point you mentioned, which caught my attention, was that the subordinate to officer ratio or clerk to officer ratio is shrinking. What is the reason for this?
And it's fairly simple, it's happening in particularly in the public sector banks. And if you see historically, public sector banks clerk to officer ratio is very, very high. About a decade back, or more than a decade back, former Bank of Baroda chairman Mr. Khandelwal came out with a report on the HR issues. There he mentioned that once you have the CBS, the core banking solution, you need to look at this. Do you keep so many clerks? And that's happening as technology progresses. Because the clerical jobs are like tailor jobs, interacting with customers, selling stuff. As we change the way banking is done, so they are becoming redundant. So what's happening is public sector banks, they're not going for VRS or asking people to quit, but they are not filling in the vacancies.
The fact that you mentioned public sector banks, have bank mergers also contributed to this shrinkage?
Not exactly, because again, a part of the bank merger, it is not sacking people or rationalizing workforce in a polite way. It was not part of the agenda. So they have been accommodated. And one thing we must remember, that in public sector banks, up to certain point, at the lower level, they are better paid than their private. So the disparity is very high at the most senior level, even the tier 2 level, but from junior to middle and between middle and senior level, public sector bankers are far better off than their private peers.
Now, you highlight that fintechs, neobanks, other tech firms are poaching away employees. Does that mean that banks need to change the incentive structures for employees?
So, yeah, that was you can call it philosophical quest I indulged in my column. And there are multiple ways people are leaving. Of course, the Other banks also are poaching. That's one part of it. And then all the challenger banks, new banks, fintechs, tech fins, and even some of them are setting up their own startups. So the question is, how do you retain them? And I have spoken to the CEOs of private sector banks, large listed private banks who have been facing this. And I see different answers. Like, for instance, one gentleman says that it's usual, nothing to be worried about. We need to have an inclusive approach. Okay. Yet another person says that, look, we probably need to go for, as you are saying, that mid-year salary hike. But another person throws a very interesting light. He said, look, money will not retain them, because this generation, the millennials, are a very different lot. The Indian ecosystem has changed, and so you need to cater to that need of them. You need to continuously challenge them. So that it's a culture change.
What can public sector banks do in this case? They are bound by different rules than private sector banks. Most of your examples are from private banks, I believe. So, what is the issue for public sector banks in this scenario?
Certainly, is a very, very relevant question. Like the stock options, which have been at least two banks I know, Bank of Baroda and State Bank of India, they've been getting dusted. I mean, lying and accumulating dust in finance ministry's some cabinet. Banks are not allowed to give any kind of those kind of incentives. Well, the CEO and the MD and the executive directors, they get some piddly bonus. I think it's 8 lakh and 6 lakh kind of thing. That's the kind of money they get. But so you can't attract talent. So the one way of doing it is recruiting from the market, which banks have done.
Taking you a bit off topic, because this was the news of the week, there's a 33% premium that the government is commanding over IDBI Bank's valuation. Is that justified?
Well, it's very difficult to say from an investor's point of view in the stock market sense, is it justified or not. But if you see, I would say almost every public sector bank, there's a great franchise. As we speak, IDBI is performing reasonably better. It has a huge pile of gross bad assets, but if you look at the net non-performing assets, it's pretty low in sync with the industry, which means it has done massive provisioning. Incidentally, its CASA, current and savings account, which is relatively low cost, is the highest in Indian banking system, if I'm not mistaken. So it's a very good franchise, and as I understand, the precondition of privatization is the government will follow a hands-off policy. Both the government and the government agent, if I may say so, LIC, will not interfere in any which way. So I think any entity which is looking for a banking license in India, it's a huge market. If you see that kind of franchise, I think 33% is not something, it's very high it's asking for. It has the potential.
Thank you. Thanks a lot for your time. We hope to see you again next week. Thank you. Tamal says the change in the nature of banking is bringing about these changes. Technology has a larger role to play. As regards IDBI Bank's valuation, he believes if the government does follow a hands-off approach, then a 33% premium on valuation is justified. Last week, we asked whether public sector banks had done enough to promote digital banking and digital payments. It's a split, with just 50.8% saying yes and others disagreeing. Although the public sector banks have launched digital banking initiatives, they have lost out to private peers in terms of payments. None of the banks have performed as well as the likes of PhonePe, Paytm and Google Pay for UPI transactions. This week, we want to take you away from the question of technology towards the issue of privatization. The government is set to give up its stake in IDBI Bank, and 2 more public sector banks will follow suit. But do you feel public sector banks need to be privatized? You can respond on Twitter, Instagram, Telegram, LinkedIn and our website. Our polls open on Friday. The PSBs have done better than private banks in promoting schemes like Jan Dhan Yojana, but they have lost out on the financial metrics. Let us know your thoughts. We'll be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.